Welcome to Plan Protect. We're going to be talking about investing in a personal superannuation fund. Saving up enough money to live comfortably when you retire is a common financial goal for which you will need to build a personal superannuation fund gradually. This is how it works. A personal superannuation fund works like a long-term savings plan where you put in money regularly into a fund managed by a super provider, typically a bank or investment companies. The money that you invest will have to stay in the fund until you reach retirement or when you begin your transition to retirement, usually after a specified minimum age. In the meantime, your money, along with the contributions of other members of the fund, will be invested in various assets such as property, shares of stock, cash, and other financial products. So what are the advantages of a super fund? Australian laws encourage people to invest in a retirement fund by providing attractive tax incentives such as imposing a lower tax rate of 15% on your super fund contributions and its earnings. Additionally, you are allowed to deduct the full amount of your contributions from your gross earnings, effectively reducing your taxable income. Some personal superannuation providers also offer additional benefits such as insurance coverage and total and permanent disability insurance, and in some cases, even income protection coverage. Financial planners recommend obtaining additional protection in case of emergency because you'll be able to access your contributions only after retirement age. Investing in a super fund also takes care of the hassles of monitoring assets and their earnings, keeping accurate records and paperwork, and compliance with super laws, all of which require much of your time and skills if you're doing it on your own. Let's look at investment strategy. When choosing a super fund, make sure that the fund strategy meets your goals and needs and exposes your money to a degree of risk that you're comfortable with. Most funds are professionally managed and are invested in a diversified portfolio to spread risks and prevent serious losses. Let's touch on diversified assets. With the unpredictability and volatility of financial markets nowadays, the best way to secure your funds against huge losses is through a diversified asset portfolio. This means spending the fund on different companies, different sectors of the market and the economy. Most funds will issue a prospectus describing the investment strategy and the asset mix consisting of safe investments like cash and bonds, as well as capital growth investments such as property and shares. How much personal superannuation is sufficient for your retirement depends on your needs, so it's best to consult a financial planner who can calculate the right amount of contributions and the appropriate fund that is suited to your own circumstances.